Scotty, two-year Treasury yields got right up against a 5% yield last week, the highest since 2007. Everyone baffled about what to do about the stock market this year is talking about buying short maturity Treasuries. Why try to figure out the stock market when you get almost 5% for 2 years risk-free? So let's talk to a recipient of all that interest. Joanna Gallegos is the co-founder of Bond Blocks, which runs a suite of ETFs that enable investors to invest in U.S. Treasuries. Joanna, we've seen big inflows into your ETFs, into short-term Treasury ETFs. Bonds are back, but should investors really start considering increasing their allocation to bonds? Remember last year at this time, 60-40 stock bond, dead. Now it's back.
Yeah. And the reason bonds are back is because yields are back. There was a tremendous shift in yields last year that was historic. So yields by the end of the year went up by 425 basis points on the Fed funds rate. That is just a huge shift. So what it means for everyday portfolios and everyday investors is that cash needs to be addressed. The things that are on the sidelines, anything that people haven't been allocating towards the U.S. Treasury space, they should now consider doing that. And we see that although bonds are back, investors aren't taking action and they're not reallocating.
So what's actionable in bonds right now?
Yeah.
We've been talking about the inflows into the short-term Treasuries.
Yeah.
You've been a beneficiary of that. But what about something else? What about corporate treasuries? What about high yield, for example? Is there any place, or should we forget about it?
High yield's really interesting because it's sort of misrepresented in terms of its risk. So definitely in terms of its risk relative to equities. But high yield, if we think about it, these issuers, there are some sectors in high yield that have really healthy cash flows right now. Think about energy, think about financial sectors. And the thing is during the pandemic, these same issuers had a chance to refinance their debt. So their balance sheets are pretty strong, and the yields in high yield are really compelling.
This is not following the usual downturn scenario for high yield at all. So that's what's leaving people so confused.
Yeah, the economic data is confusing. There's strength still in the consumer. There's strength still in the jobs market. There's been strength, relative strength in earnings, again, by sector, by different type of product, different type of industry. But the spreads, the difference between the risk-free rate and some of these rates in corporates have not widened to the places that they widened to in the GFC or pre-pandemic. They're still relatively moderately increased from last year. So it's a different type of environment and doesn't look as distressed.
And a tough one to figure out. Now, we're going to have a lot more on investing in bond ETFs. That's going to be coming up on ETF Edge at 1:10 p.m. Eastern Time. You're going to hear more from Joanna about why high yield should be reconsidered, how they have it in their ETFs. She's going to be joined by Kim Arthur of Main Capital. That's etfedge.cnbc.com. Scott, back to you.
All right, Bob.